Imagine you're a middle-class American in the late 1970s. You've got a steady job, family, a mortgage that feels reasonable, and a savings account that used to feel safe. But something's wrong, and you can feel it in your bones. The price of milk keeps going up, so does gasoline, so does rent. Your paycheck, while bigger on paper, buys you less at the grocery store every single month. It's like you're running on a treadmill that keeps getting faster. You talk to your friends, you talk to your banker, you read the newspapers. Everyone says the same thing: don't worry, it's temporary. But temporary has been going on for about 5 years now, your wife asks. So what are we supposed to do with our money? That's the scene. That's the feeling. And into that anxiety steps a particular solution that feels almost obvious. Hard money. Real stuff. Metal you can hold. Because somewhere in your chest, you understand something that nobody wants to say out loud yet. When governments print money too much, the value of that money gets thinner. It's like water that's been watered down. You can still drink it, but it's not as nourishing. This belief that something real is better than something printed is not new. And in the late 1970s, with inflation eating away at the purchasing power of the dollar, the urge to own something tangible became almost magnetic. Enter silver. Not as a stock, not as a fund, but actual physical silver. Bars, coins, anything you could hold and touch and verify was real. And if you were wealthy enough to move fast and big, you didn't just buy a little silver, you bought a lot of silver. It's like a significant fraction of the world's supply. That's where our actual story begins. And the main characters are two brothers from Texas named Nelson Bunker Hunt and William Herbert Hunt. The Hunts were old money, oil money, inherited money. The kind of wealth that gave them the confidence that their instincts were probably better than other people's instincts. By 1979, they had decided that silver was going to protect them from what they saw coming: currency debasement, inflation, and the collapse of trust in paper money. So they started buying, not casually, not as a hedge, but deliberately, methodically, with borrowed money, to accumulate what would eventually amount to roughly 1/3 of the world's above-ground silver supply. That's not investing. It's trying to own the game board. At first it worked like a charm. As the Hunts bought, the price of silver rose. It went from around $6 an ounce in early 1979 to $10, then $20, then $30. Then in January 1980, it spiked all the way to nearly $50 an ounce. In just a few months, the Hunt family's position had swelled to be worth billions and billions of dollars. On paper, they looked like geniuses. The media covered it like a dramatic story: Texas billionaires trying to corner the silver market, betting against the paper dollar, challenging the system itself. Some people saw them as heroes standing up to currency debasement. Others saw them as reckless speculators. Either way, the world was watching, and the message they were sending was clear. Hard money wins when the paper game gets rigged. But here's where the story gets interesting, and also deeply revealing about how systems actually work. When the people who run the financial system see that the financial system itself is being threatened, not by bad policy or bad luck, but by someone actually trying to own a critical physical commodity and force the issue, they don't just accept it. They adapt. They use the only tool they really have. They change the rules. In early January 1980, the commodity exchange COMEX, the place where silver futures traded, did something that, on the surface, looked very reasonable and technical. They introduced what they called Silver Rule 7. It placed heavy restrictions on how much silver you could buy on margin borrowed money. It raised the cost of entry, made leverage, which had powered the Hunt brothers' entire strategy, much more expensive and risky. Officially, this was about market stability and protecting the system. Unofficially, it was about protecting the system from the Hunt brothers' very effective bet against it. The message, if you were paying attention, was simple: we can change the rules whenever we want, and we will. What happened next was almost mechanical. With the rules changed, with leverage becoming toxic, the Hunt brothers suddenly couldn't fund their buying anymore. In fact, they weren't just unable to buy more, they were now facing margin calls on what they already owned. They had to sell at higher and higher intensity, and as they sold, prices began to fall. In just a few days, silver crashed. The price fell from $21 to $10 in what felt like a moment. On March 27, 1908, each of the day that became known as Silver Thursday, the entire dream collapsed. What had been a multi-billion-dollar fortune became a massive debt that took years to unwind. Not all of it went to zero, but for practical purposes, the Hunt brothers had tried to fight the system, and the system had won, quickly and decisively. What's crucial to understand here is that the Hunts lost not because silver was bad, it's not because they were stupid, but because they tried to force the system to bend to their will using an actual physical commodity. And the system responded by saying, okay, physical commodity or not, we make the rules around how you access the market, and we can change those rules anytime we want. That message echoed through financial history. For ordinary people watching in 1980, the lesson seemed to be, if you try to own hard money in a way that threatens the paper system will use its institutional power to shut you down. Don't fight it. Don't try to corner anything. Just accept that the rules of the game can change in an afternoon. Most people internalized that lesson so deeply that they stopped even thinking about hard money as anything other than a fringe idea. Banks and mainstream financial advisors made sure to mention it occasionally, usually to dismiss it. Physical metals are clunky, inefficient, old-fashioned, they'd say. Meanwhile, behind closed doors, institutions quietly accumulated precious metals for their own strategic reserves. The Hunt brothers' story also established a precedent if you tried hard enough. The system would respond, and that response would use the regulatory apparatus to protect its own interests. Now, let's jump forward to today. For the past few years, there's been a quiet conversation happening in certain corners of the internet. In forums, in YouTube videos, and among people who remember the 1980s and never forgot what happened. And that conversation is about something that looks very similar to the Hunt brothers era, except distributed, invisible, and much more complex. It starts with a simple observation: the amount of paper silver that trades on COMEX, the futures market, where people buy and sell claims to silver, without ever taking physical delivery, is staggeringly larger than the amount of actual silver available for delivery. The ratio has been reported anywhere from 2,501 to 3,781. In fact, for every actual ounce of silver that could be delivered, there are hundreds of ounces of paper claims trading. By contrast, the ratio has sometimes been much tighter. But over decades, it's been allowed to expand and expand. And with that expansion comes a truth that is uncomfortable to financial institutions: the entire paper market is built on the assumption that most people will never ask for physical delivery. It assumes that people will be content to trade paper promises back and forth forever without demanding the actual stuff. That assumption has held up remarkably well, by the way. But it's held up through a combination of: 1, consistent messaging that physical silver is archaic and inefficient; 2, active price management making physical silver look expensive enough that paper seems like a better deal; 3, the fact that most investors are simply taught that owning paper is normal, sufficient, and the only sophisticated way to play commodities. The combination of these factors has meant that the massive paper-to-physical ratio hasn't caused a crisis. It's just a feature of the system, a feature that benefits institutions that control the paper markets, and a feature that the institutions have every incentive to preserve. But this is where things get interesting for our current moment. There are circumstances where that assumption gets tested. When manufacturing demand for silver spikes, when geopolitical tensions make people nervous about currency values, when a whole bunch of people suddenly decide at the same time that they don't trust paper anymore. That's happening now in various ways and intensities. The reason this matters right now is not that we're on the verge of a Silver Thursday repeat. The system has learned. It's much more sophisticated now. But the underlying dynamic, the tension between a paper claim system and the physical stuff underneath it, is still there. It's just more abstract, more institutionalized, and harder for an average person to even see, let alone understand. People talk about big money wanting your gold and silver now. Some of this is overblown YouTube rhetoric. But some of it points to a real shift. Large institutions, nations, and wealth managers are actually accumulating physical precious metals again, quietly. Not because they've become doomsayers or lost faith in the system, but because at certain levels of wealth, physical metals are treated as a strategic reserve, a piece of your portfolio that you simply hold outside the paper system as insurance. Meanwhile, the marketing to normal people remains consistent. Metals are risky, volatile, old-fashioned. Paper is efficient, modern, and easy. Own paper. That's the current event that anchors this whole conversation too right now. The paper-to-physical disconnect is widening again. Attention to it is growing. The system is once again managing how people think about and access hard money. It's just using different tools than they did in 1980. Okay? So let's step back and name what's actually happening here. What we're talking about is something called currency debasement and hard money suppression. And it's a cycle that has repeated itself dozens of times across different countries, different eras, and different specific commodities. Here's how it works. Early stage, a government or central bank decides it needs flexible monetary policy. Maybe there's a crisis. Maybe there's war spending. Maybe there's social programs that need funding. The solution is straightforward. Create more money. Lower interest rates, make borrowing easier. It's the path of least resistance, and it works at first. The economy gets a boost. Spending increases, employment rises. People feel optimistic. Debt is cheap, so everyone takes on more of it. Governments, companies, individuals. It feels great, and it feels like it could continue forever. But it doesn't, because more money chasing roughly the same amount of goods tends to make prices rise. Inflation starts to creep in. Middle stage inflation becomes persistent. People notice. Prices at the store are higher. Your paycheck buys less. Wages have to rise to keep up. As wages rise, companies raise prices again. It becomes a loop. Central banks say it's temporary, but temporary keeps being extended. Interest rates stay low because raising them would cause a recession, which nobody wants politically. During this stage, people who are paying attention start to get uncomfortable. They look at their savings and realize that just holding cash is a losing bet, so they start reaching for alternatives. Maybe stocks, maybe real estate, and maybe, especially if they're wealthy and patient, hard assets, gold, silver, land, anything that can't be printed. Later stage hard money starts to outperform. Prices for precious metals rise. Media coverage increases. More people start to pay attention and think, wait, maybe I should own some of this too. The price rises create momentum, and momentum attracts the people who were skeptical before. A story forms. Hard money is the answer. Paper is being debased. Own the real stuff. Sometimes this stage leads to what we call a mania. People buying metals not as insurance or as a portfolio piece, but as the main bet, borrowed heavily, expecting prices to keep rising. This is when you get the Hunt brothers scenario. This is when you get crowds of retail investors convinced they're on the right side of history. At some point, the paper system, the financial institutions that depend on leverage, that profit from the expansion of credit, that have built their business models around paper trading starts to feel threatened. Not because hard money is inherently dangerous, but because a system that runs on confidence in paper cannot coexist indefinitely with a strong and visible alternative. So the system responds. It doesn't usually do this overtly. Instead, it uses its regulatory power to change the rules around how people can access hard money markets. Manages the narrative, subtly emphasizing the inefficiency of physical metals and the sophistication of paper markets. Uses price management tools to make hard money seem expensive or risky or unstable. Ensures that the barrier to entry for ordinary people acquiring hard money remains high, both psychologically and financially. The goal isn't to prevent people from owning hard money. It's to keep the paper system in the position of being the default. It's the accepted, the professional way to invest and store value. And remarkably, this strategy works. Most people end up following the path of least resistance, which is paper. They own stocks, bonds, bank accounts, retirement funds, layers of paper claims. They hear about hard money as a curiosity, a relic, something for preppers or gold bugs, not serious investors. The cycle doesn't end there. It repeats. Because eventually, if currency debasement continues long enough, if the gap between the amount of money printed and the amount of real productivity grows, you get another crisis, another loss of confidence, and the cycle starts again. What makes this cycle so insidious is that it's not wrong to prefer paper for most purposes. Paper markets are efficient. They allow leverage. They're accessible. They're how most wealth is created and transferred. Problem is that those same efficiencies can be abused. And the system that benefits from that abuse is the same system telling you that hard money is inefficient. Now, with that framework in place, let's be very specific about what's similar between 1980 and today, what's different, without pretending we know what happens next. What's similar? The core anxiety is the same. People are worried about the value of their money. Inflation is real, not imaginary. Debt levels are historically high. Governments and central banks have used unprecedented monetary policy tools. And underneath all of it is a valid concern. If a system just keeps printing money, doesn't that eventually make the money worth less? The response is similar to wealthy people and institutions are quietly accumulating physical precious metals, not in a way that makes the front page, but systematically as a hedge against currency risk. And ordinary people, watching the news and feeling the squeeze, are asking questions about whether they should do the same. The paper-to-physical ratio issue is similar. We have massive amounts of paper claims on silver and gold trading every day, with relatively small amounts of physical metal underneath. This imbalance has grown because it works as long as people keep treating it as normal. And the system's response is similar. Use messaging, regulation, and price management to keep hard money in the position of being alternative or fringe, while paper remains the accepted, efficient, professional default. What's different? In 1980, you had very visible actors, the Hunt brothers trying to corner the market. Today's dynamic is more distributed. You have sovereign wealth funds accumulating metal. You have central banks doing the same. You have major institutions managing positions. You have millions of retail investors interested in it. There's no single villain or hero, it's just forces. The tools available for managing prices in markets are far more sophisticated. You can manage leverage, create new paper products, use derivatives, offer cash settlements instead of physical delivery. In 1980, they had to change one rule, Silver Rule 7, and it worked. Today, the system has hundreds of tools. The information environment is different too. In 1980, the media told you one story and you had to accept it. Today, you can find 100 different YouTube channels telling you 100 different narratives about silver, banking, and manipulation. Some are accurate, some are overblown. All of them exist in an attention economy where the most extreme version tends to get the most views. And finally, the global context is different. Today's central banks themselves are actively reconsidering their relationship with gold and precious metals. Nations are diversifying reserves. The financial system is under strain in different ways than it was in 1980. It's more complex, more interconnected, and more fragile in some ways. So what does understanding all this actually change about how you should think? Not what you should do, but how you should think. First, it gives you context for the anxiety. You're not crazy if you feel like the system is rigged. You're not paranoid if you notice that big institutions have capabilities that small investors don't. You're not ignorant if you sense that the messaging around hard money is inconsistent with how it is actually treated behind closed doors. The system is structured in ways that benefit institutions over individuals. It's not a failure, it's kind of the point. Institutions have economies of scale. They have information advantage. They can hold assets for very long time periods without needing liquidity. Those are real advantages. But the anxiety you feel isn't primarily about institutions being evil or intentionally deceptive. It's about incentives. The system is optimized for its own continuation and stability, not for making sure that every individual investor has perfect information or perfect access to every asset class. Understanding that takes some of the psychological sting out of it. You're not being targeted. You're just not the center of the system's decision-making. Second, it helps you see the hard money versus paper framing as more subtle than the YouTube titles suggest. Big money wants your gold and silver now. Manipulation explained. There are videos with that kind of title that get watched by hundreds of thousands of people. They're pointing at something real. Institutions are accumulating metals. There's price management happening. The paper system does benefit from people staying in paper. But the conclusion that you should rush out and buy physical silver because the system is collapsing is only one interpretation, and not necessarily the most accurate. The institutions accumulating metals aren't doing it because they think the system is about to collapse. They're doing it as a prudent hedge, as insurance, as a long-term strategic reserve. The difference is important. Insurance is different from prophecy. You buy insurance not because you expect disaster, but because disaster is possible and would be catastrophic if it happened. That's a sane reason to own hard money. The sane reason is not the system is about to collapse and I am going to get rich quick. The system is very good at preventing quick collapses. It's been stressed many times and found ways to adapt. Could it fail in some form? Sure, that's theoretically possible. But it won't happen because a YouTube video predicted it, or because the paper-to-physical ratio is high. It would happen because of very large, slow-moving structural changes, and those are not timing-able. Third, it changes how you interpret price movements. If you own physical silver or gold, or if you're thinking about it, the question, why did the price move, now has more context. Sometimes it moves because of supply and demand. Sometimes it moves because of real inflation concerns. But sometimes often, actually it moves because of positioning in the paper markets. Because of leverage being unwound, because of algorithmic trading, or because of explicit price management. That doesn't make the price meaningless. It just means the price is more complex than supply and demand. It's a price for the physical stuff, plus a price for all the paper leverage sitting on top of it. Understanding that means you can be less reactive to daily or weekly moves. You can recognize that volatility is a feature of a system with high leverage, not a sign that your decision was wrong. Fourth, it helps you avoid the two biggest emotional mistakes people make during these cycles. Mistake 1, panic and paralysis. You look at the debt levels, the money printing, the paper-to-physical ratio, and you freeze. You don't know what to do, so you do nothing. You hoard cash, or you avoid thinking about it, or you just assume it's all too complicated for you. This is how people lose to inflation in slow motion, not because they made a dramatic mistake, but because they made no move at all while prices slowly ate their wealth. Mistake 2, mania and overextension. You look at the same things and conclude that everything is about to blow up. You move a large portion of your assets into hard money. You borrow to buy more. You become convinced that you've seen the truth and everyone else is asleep. This is how people become vulnerable to rapid drawdowns, like what happened in the 1980 Silver Thursday crash. The healthy place is in the middle, acknowledging that the system has legitimate vulnerabilities, that hard money has historically been a prudent insurance policy, but also acknowledging that timing when that insurance pays out is not possible, and that overextending yourself for any single bit, even a sensible one, creates new risks. Let me put this a different way, because it matters. When you understand the currency debasement and hard money suppression cycle, you can see that the world is not divided into truth-tellers who see collapse and sheep who don't know what's happening. Instead, there are people with different time horizons, different risk tolerances, and different structural positions in the financial system, all of whom have legitimate reasons for their choices. A person who holds paper assets is not necessarily asleep. They might simply have a time horizon where the system is very unlikely to break in a way that matters to them. They might have income coming in, so they don't need to preserve capital as much as generate returns. They might prefer the liquidity and ease of access that paper provides. A person who owns physical precious metals is not necessarily a brilliant contrarian. They might simply be someone who worries about tail risks, who has enough capital that they don't need to be fully efficient with it, or who values optionality, the ability to have assets outside the system. Both can be rational. Both can be reasonable. What matters is having some understanding of what's actually happening, rather than outsourcing your thinking to someone's narrative. Whether that narrative is stocks always go up, or the system is about to collapse, outsourcing doesn't protect you. It just makes you vulnerable to whoever is selling the loudest narrative. One more piece that matters, and then we'll wrap up. History is full of moments where people were correct about the problem. Currency debasement is real. The system does have vulnerabilities. Institutions do have more power than individuals, but wrong about the timeline and the solution. The Hunt brothers were correct that inflation was real and that hard money was a legitimate hedge. They were wrong that they could force a corner and beat the system in a direct confrontation. They tried to play a game where the other players controlled the rules, and those players changed the rules mid-game. People in the 1970s who worried about the dollar's weakness were correct. The dollar did lose a lot of purchasing power. But those who expected an immediate collapse or who tried to time a specific event mostly didn't do as well as those who simply diversified, hedged, and moved forward with their lives. Right now, in 2026, if you're watching video after video about silver manipulation, about COMEX paper to physical ratios, about banks hiding the truth, you might be identifying real structural issues. But you might also be falling into a trap where you're refocusing so much on the problem that you miss how systems actually evolve. The financial system probably won't collapse in the way you might fear. It's more likely to adapt. In fact, it's probably already adapting as we speak. This doesn't mean that hard assets like gold or silver are useless. It means they serve a different purpose. They're insurance, and they create options, not a bet on timing the market perfectly. So, what have we learned today? We've taken a deep dive into history, looking at the 1980 Silver Thursday crash. The goal wasn't to predict the future, but to use it as a case study. A real-world example of how the constant tug-of-war between hard money and paper money systems actually plays out. We've explored the long, repeating cycle of currency debasement and the suppression of hard money, a pattern that echoes across centuries and civilizations. We've compared that historical cycle to our current financial environment, noting the striking similarities and the crucial differences. Most importantly, we've discussed how understanding this cycle can completely change the way you think about financial anxiety, about wild price swings, and about the choices you have in front of you. The purpose of this isn't to make you panic. It's not to convince you to buy or sell anything. The entire point is to give you context. When you have context, you're far less likely to get swept away by fear-mongering narratives or hyped-up stories. You're more likely to stop and ask the right questions, become better equipped to make decisions that are truly right for your own personal situation. Rather than choices driven by the fear of missing out on a rally or the fear of a coming catastrophe, here's what history really teaches us. Large systems, like our financial system, are much sturdier than any single chaotic moment might suggest. Crises absolutely happen, but they almost never unfold in the exact way people predict. Hedges, like holding some physical assets, are worth having, even if you never have to use them. Because on the day you do need them, you'll be incredibly grateful you had them. And patience, that boring, unexciting virtue, almost always leads to better outcomes than trying to perfectly time the next big market move. This is the core philosophy of this channel. History doesn't predict the future, but it provides invaluable context. And context is the very thing that prevents you from making panic decisions during a crisis, and from making manic, FOMO-driven decisions when everything feels a little too good to be true. It's about finding that calm, rational middle ground. If that's what you're looking for, perspective, historical context, and a calm voice to help you understand what's really happening beneath all the noise and headlines, then this channel is for you. Subscribe to Chill Financial Rewind if you'd rather understand the world than panic about it. There's no hype here, no crystal ball predictions, no promises of 4-digit silver prices. We just offer real, historical context and a few sarcastic observations about how we humans keep repeating the same financial patterns. It's just with slightly different costumes each time. Thanks for watching, and I'll see you in the next one. Take care.